Okay, we're going to get started. Just want to make sure that it's recording, and it is. For those of you that are here for the tax gift explanation, I call this the tax gift explanation made simple. Don't like to use for dummies, but that's kind of the lineup that we have. My name is Linda Hillman, and I am the CEO and founder of Done Right Financial Solutions. And today we're going to talk about the gift or not to gift, the gift tax. Also, for those of you watching in the replay, my contact information will be up on the last slide, so you can get in contact with me if you have any questions, comments, or concerns. Also, you can ask any tax questions that you may have, or financial credit, budgeting, anything along that line. That is what we do for Done Right Financial Solutions. So again, I am Linda Hillman, founder and CEO of Done Right Financial Solutions. I am currently applying for my enrolled agent application with the IRS, which will make me a licensed enrolled agent. Listed on the website right now, I am a senior tax analyst, and I've worked for H&R Block. I've worked in taxes over the past 40 years. I've been an instructor for H&R Block. I'm also an independent FES agent, which is the other part of the financial services that I offer in the credit restoration that I offer to my clients. And then I specialize in credit and budget financial coaching and wealth building. So this is what we do at Done Right Financials, and I am happy to have you a part of today's webinar. So real quick, our agenda for today is going to be what is the tax, the gift tax? When do you need to report it, and how do you report it? And we're not going to talk a lot about that because we're really going to stay on the side where you don't need to report it, but I am going to let you know when you need to report it, and you'll find it very interesting how lenient the government, or the IRS is, I should say, for this credit. And it's really not a credit, it's an exclusion, but we'll get more into that a little bit later in the presentation. And then we have, at the end, we're going to do questions and answers. And since I'm recording this, I understand that there may not be a lot of live questions. I did invite some people to come, and hopefully they will show up and ask questions. But if not, like I said, there will be a time at the end where you'll see my contact information. And when you are viewing this, you can definitely reach out to me at that time. So let's get right into it because we don't want to belabor the time. So what is the gift tax? The short end of it, or the common definition that we want to look at, is it's the annual federal gift tax exclusion that allows you to give away up to $15,000, and this is in 2019, to as many people as you wish without those gifts counting against your 11.4 million lifetime exemption. So after 2019, the 15,000 exclusion may be increased because of inflation. And we know that 2020 has been a different type of year. And so I'm pretty sure that it's either going to remain 15,000 or it's going to increase, but we won't know that until they upgrade or update the tax law, and they normally do that around September, October. So once we know that for sure, we'll know if you can give a little bit more, or if it remains the 15,000. But for right now, 15,000 is the amount that you can give away to as many people as you wish without those gifts counting towards your 11.4 million lifetime exemption. And we're going to talk about that in a little bit and give you an example of what that looks like. So again, what is the tax gift? Now, I gave you the the everyday common definition of it. So let me give it to you the way the IRS gives it. And this is quoted from publication 559 on page 25. It says the gift tax applies to lifetime transfers of property from one person, the donor, to another person, the donee. It's very important that you understand the donor and the donee. And what we're talking about today is more towards the donor than the donee. But the same applications or the same rules apply to the donee. Now, again, the donor is the one giving the money, the donee is the one receiving the money. So again, the gift tax applies to lifetime transfers of property from one person, the donor, to another person, the donee. A gift is made of tangible or intangible property, including money. So that means including cash money, check, credit, however you transfer it. You have got to understand when they are talking about cash money, it does not matter the form that you give the money. And it's very important. I'm going to do a different video on the banking law that kicks in when you don't, or when you deposit a certain amount of money into the bank and what the bank has to do legally. There'll be a different one, so I'm not going to talk about that now. But just remember that the number for the gift tax is 15,000. The number for the bank reporting is 10,000. So those are two different numbers, and they do not coexist or live together. They are not married to one another. If you can give up to 15,000 for the gift tax exclusion, but it's up to 10,000 that the bank is required to report anytime you make a deposit of cash. And that doesn't mean that you just walk into the bank and make the deposit. It means you transfer from an account to an account. You go from Cash App to your bank, or vice versa. They have a special law that they have to go by. It covers banks. Fintech banks are banks that are online only, and then what we call natural banks or physical banks like Wells Fargo, Bank of America, et cetera, et cetera. Okay, so I just wanted to drop that little bit right there. And again, I will go into more details on another video about that banking law. So it includes cash, money, the use of property, or the right to receive income from property given without expecting to receive something of least equal value in return. If something is sold for less than its value, or if a loan is made without interest or with reduced less than market rate interest, a gift may have been made. And so now what they did, they gave you their definition of the gift tax, and then they said this is what it looks like in the real world. If you sell a house for less than its full value, or you make a loan and you do not charge interest, or you reduce the interest to less than market rate, that may be considered a gift. And so it's really important that you understand that. It's really important that you understand that giving a gift is the criteria for this exclusion to kick in. And again, you only have 11.4 million that you can give away tax-free in your lifetime. If you go over that, there are other implications, and we're going to kind of go over that a little bit here in this video, but I want to keep it simple. I don't want to go too far deep in it. So if you have some specific questions, you can definitely reach out to me with your specific questions. So now that we know what the gift tax is, let's break it down. So here's the example. Say you give two favorite relatives $20,000 each in 2019, and you give another relative $10,000. The 20,000 gifts are called taxable gifts because they exceed the 15,000 annual exclusion. But you won't owe any gift tax unless you've exhausted your lifetime exemption amount. Remember, the lifetime exemption amount is $11.4 million. So even though you've given $20,000 to two different individuals, and remember, this is a per person. If you're taking notes, you want to write per person, 15,000 per person. I can give up to 15,000 per person to as many people as I like, and it is not taxable. That is what the gift tax says. But it's not saying that you can only give 15,000. It's saying that that will be the annual exclusion where the money does not have to be reported. Now, if you give more than 15,000, say you give 15,100, or you give 20,000 or 40,000 or 50,000, then you have to report that you gave that information or you gave that money away and to whom you gave it. But you won't owe any gift tax on it unless you've exhausted your lifetime exemption. So basically, it's a kind of a safety net that you have up to 15,000 that you can give away and not report it. If you do give away at any time more than 15,000, but you have not exhausted that $11.4 million in your lifetime, you're still not going to be taxed. This is a wonderful and a powerful tool that individuals and businesses need to know, because when you know this, you can then govern yourself. And when you're trying to build wealth, when you're trying to get yourself out of a financial situation, when you're trying to become stabilized in your finances, this is going to help you because you now understand that. Now, I also got to put in here before I go on and do the rest of the example, I want to put in here that this does not have anything to do with charitable contributions. A lot of people get those two mixed up. Charitable contributions are something totally different than the gift tax. The gift tax, you're giving from person to person, from business to person. It can be in a trust. It's also considered inheritance. So all of that is what falls under the gift. So it's not, when you pay your tithes and offering to your church, and when you give to a 501c3 charity, and we'll talk about that in a moment. So assuming you haven't exceeded your lifetime exemption of $11.4 million, the two taxable gifts simply reduce your lifetime exemption by $10,000. Well, Linda, how do you figure? Well, I'm glad you asked. So remember, you gave 20,000 to two different people, right? So you take the 20,000, you minus the 15,000 that is your annual exclusion. So basically, it's $5,000 that you are reporting to the IRS, because that $5,000 excludes the 15,000. So you go 20,000 minus 15,000 times 2 equals 10,000. Again, 20,000 plus 20,000, that's $40,000. You minus the 30,000, that is the exclusion. That leaves 5,000 from each 20,000 left over. You times that by 2, that gives you your 10,000. So you are reporting the $10,000. And again, there is no tax that is going to be applied to that amount unless you've passed or surpassed your $11.4 million. The other gift of 10,000 is ignored because it is below the $15,000 annual exclusion for 2019. So basically, you're reporting that $10,000. You're not reporting $50,000, which is what you've actually given away. You're only reporting that $10,000 because the $5,000 over the $15,000 that you were supposed to give, you gave that to two people. So hopefully that makes sense. And then I have a note here that I'm just going to read. It says, if you give 3 individuals $15,000 in 2019, these gifts are ignored because they do not exceed the annual exclusion. So 15,000 is the annual exclusion. 15,000 or less that you give someone, you do not have to report it. You do not have to put it on your tax return. You just act like it didn't happen, okay? Anything over 15,000, you get to 15,001, $15,000 and one, $15,001, you got to report that $1, okay? So remember, 15,000 is the cutoff. So again, I mentioned that it's different from charitable contributions. So among the following types of gifts are exempt from the federal gift tax, so you can make unlimited gifts in these categories without any gift tax or estate tax consequences, and without having the gift tax or having to file gift tax returns, okay? So gifts to the IRS approved charities, that means that when you go to irs.gov, they have a list of people who have apply for a 501c3 or a 501c4 or a 501c whatever, and they are considered a nonprofit organization. They have a list of those. So if you give a gift to an IRS approved charity, that does not count against your $11.4 million gift tax, and you can give as much as you want. There is no exclusion. Now, the reason why you do that is because it is tax deductible, and you can then write it off on your Schedule A, okay? So businesses do that and individuals do that to take advantage of what we call charitable contributions. And basically, according to the Job Acts, the job, what is it called? The Job Acts that just passed with under Trump, basically now you can give up to 60% of your adjusted gross income as an individual, okay? So your adjusted gross income as an individual, let's say you made $50,000 in adjusted gross. That means that your total gross income has been reported and any deductions have come out. And once those deductions have come out, then your adjusted gross or your modified gross income is, say 45,000 or 30,000. And so based on that 30,000, you can give up to 60% of that in charitable contributions. Now, with the CARES Act, there is a clause in the CARES Act that is saying that everyone that gives at least $300 or more can write off, even if they cannot itemize, they can write off $300 of charitable contributions because of 2020. And so and when I say because of 2020, because of COVID and because of the era that we are in, that's kind of a tax break for every individual, whether they can itemize or not. So now we have this. Normally when I have a client that comes in, and this again, they give to their church, they give tithing and offering, they give to Goodwill, they give to not Blue Cross, but they give to Red Cross or something like that. They didn't have enough to itemize. And so I would put it on there because maybe on the state end they would have enough, but on the federal end they wouldn't have enough, and I would put it there. However, my system would say, okay, well, they really don't have enough to itemize. Do you want to force it or do you want to take standard? And what I would take whichever is best for the client. But here, you will be, whether you itemize or not, you will be allowed that $300 or whatever you give in charities, okay? But again, that is to IRS approved charities, gifts to your spouse, assuming he or she is a US citizen. So if they're not a US citizen, gifts to them is called support. It's not called a gift, okay? And then gifts covering another person's medical expenses as long as you make the payments directly to the medical service provider. So you can't give it to them to pay for their medical bills. You have to pay their medical bills for them. Okay, so you may see some some charities will say, we will pay your bills for you, but you have to give us your account information so we can do that. That's the reason why they are doing that, because they want to be able to gift it and to be able to write that off on their taxes that they gave to these different organizations on the behalf of these certain people, especially for businesses and charities. But if you do it, you have to pay the medical service provider, and it's not something that you report on your taxes, okay? Again, these gifts are tax exempt. And then we have gifts covering another person's tuition expenses as long as you make the payments directly to the educational institution. So once again, you have to make the payments directly to the place that you are paying, not to the person, okay? Payments for room and board, books and supplies don't qualify for this exemption, but you can cover those costs by making a direct gift to the student under the annual exclusion. And so basically what they're saying is that if you decide to make payments for room and board, books, supplies, you can give the money directly to the individual that goes to the school as a gift. And if you give them more than $15,000, you report the overage. So again, going back to our example, if I give my daughter $20,000 and says, hey, look, this is going to pay for your books and your supplies, your room and board, then I would have to report the $5,000 over the $1,500. And that $5,000 will come off of my lifetime $11.4 million limit, okay? So if you have any questions on that, please reach out to me if you need clarity. So now we've come to the part where there are questions, and since I don't have anyone here to ask questions, I'm not going to belabor the time, but hopefully if you need to get in touch with me, there is my contact information. Again, my name is Linda Hillman. I am the founder and CEO of Done Right Financial Solutions. I can be contacted at the phone number and the email get listed. I'm also on social media, Instagram, Twitter, LinkedIn, YouTube, and Facebook. And coming soon, within the next week or so, we will have our website up. So you can go to our website. All of that information is there. So you can take a screenshot of that or write down the information. I look forward to assisting you in your tax needs. I look forward to assisting you in your financial needs. Again, if you have any tax or financial questions that you want to ask on either building your wealth, I specialize in small businesses, solo entrepreneurs, and small businesses. You can come to me and I can definitely help you grow that business and get it where it is, it aligns with what the IRS says, and I can tell you what entity formation would be best for you for whatever it is that you're trying to do, whether you need to be a corporation, an S Corp, a LLC, or a sole proprietor. A lot of people, I'm going to do a video on the benefits of being a single person limited LLC or a sole proprietor, because a lot of people don't understand the benefits of either. And so I'm going to do the either or and give you the pros and cons of both. A lot of people talk about, you know, I want to do a home-based business because I get all of these tax write-offs, which are good if you're not going to really scale your business. But if you're going to scale your business and you're going to make, you know, 6 and 7 figures in your business, you may want to rethink that and restructure it a different way so you can get all the benefits that come to you as a employer, that come to you as a business, and some of them are not available when you are a home-based business or an entrepreneur or a solo entrepreneur, okay? So that is it. My name is Linda. Again, I look forward to hearing from you with your questions, your comments, or your concerns. Or if you just want to chit chat about, you know, giving circles or whatever it is, or how that affects you and what's a good strategy. Hate to use the word strategy, but it's the only word that's coming to me. What's a good strategy in growing your business or growing your money? And what that looks like for you as a tax professional, someone who needs to pay taxes. How do you know how to report that? Because again, remember, on your taxes, you have to report all income, whether it's taxable or not taxable. You have to report it. And so that's on the donee side. Now, on the donor side, you don't have to report that you're giving it unless it's 15,000 or more, or I should say over 15,000. But when you're receiving it, you do have to report it, but the tax professional that you go to needs to know how to say this portion is not taxable. So another video, we'll talk about that. Hopefully you learned something today. Again, if you have any topics that you would like me to cover, any questions, any comments, any concerns, reach out to me. My contact information is there. Again, thank you so much for joining me today on this series. There will be a lot of little short videos, I guess is what I'm trying to say. A lot of short videos that will talk about this. I'm going to have some W-4 planning videos, some understanding what gross income means and how to report it, and you know, the write-offs for solo entrepreneurs and for small businesses, and the difference between, you know, corporations, S corp, you know, all of the different things and the pass-through laws and all of that. We're going to be talking about it. We are going to make taxes simple for the individual. Now, I'm not going to teach you how to do it because that's what I do, right? But I am going to give you the information so you know the right questions to ask when you're sitting down in front of your tax professional. And when you are sitting down in front of your tax professional, if your tax professional can't answer those questions or doesn't know about something that you have heard on these videos, you may want to collect your documents and go somewhere else. That's all I'm saying. You have a wonderful day. Until next time, this is Linda at Done Right Financial Solutions.